Stocks in the fast casual sector have been soaring recently. You've got technology developments and alternative meats that are creating some strong tailwinds. Restaurant Brands, the owner of Burger King and Tim Hortons, is up 41% year to date and reports quarterly results on Friday. Starbucks is up by 49%. And then there's Chipotle, which is up 85% for the year. Dunkin' earnings beating estimates this morning. That stock is up 25% year to date. Joining us right now for a look at what's working in the sector and what he thinks is likely to continue working is Will Slabaugh. He is a senior restaurant analyst at Stephens, and it's good to see you, Will.
Good to see you. Thanks for having me.
So what do you think? This is some pretty phenomenal moves from some of these companies. Do you think gains like this can continue for any of them?
I think it can for a lot of them. The first point I'd make is the consumer is in a really healthy spot. We're seeing these companies you mentioned really drive a lot of ticket growth. So the consumer showing that he or she is really willing to trade up, add on, spend more money at their favorite restaurants. The interesting point of that is Starbucks is the only one that you mentioned that's actually driving transaction growth. Most of these same-store sales gains are coming from average check, where the consumer is saying, I'll come about the same amount, but I'll spend a lot more money because I'm feeling healthier. So overall, I'd say good consumer, but we would like to see a little bit more traffic.
You know, that's interesting. That was certainly the case with McDonald's. They came out and said that people were willing to spend on the more expensive items. They don't have to offer a lot of those discounted items anymore. And McDonald's did a good job of pivoting towards that trend. I know McDonald's is one of the companies that you like. What else do you like about it?
Yeah, so I think McDonald's is doing a lot of the right things now, where there were a lot of initiatives that sort of slowed the franchisees down a little bit last year. This year, they focused on value, the 2 for $5 mix and match value platform, which is a slightly higher price value platform, but it still communicates value. So you get more check out of the customer. They still come to the store, but you're getting, again, a little bit more profit out of that transaction. So I think that's been good. They've slowed on the remodels a little bit, which is, again, giving the franchisees a little more time to sort of deal with the operational side of the business. They're speeding up the drive-through, which is helping out a little bit as well. So, yeah, I think McDonald's is really focused on the right things this year. You pointed out QSR, so Restaurant Brands International, with their Burger King business. They're focusing on menu innovation, and the Impossible Whopper launch, I think, is going to be a big deal. So QSR is one of our favorites as well. And one that you didn't mention that I think is doing some good things, but the stock's gotten hit, and we think it's a buying opportunity, is actually Domino's, which was a home run stock for a long time. It's pulled back, and I think is interesting here.
It's pulled back, but you think the sell-off has been overdone and that the company's kind of figured its way out? Some of those big issues that have been overhanging it with the CEO and things, that's just going to pass by?
I think it will. So a lot of what people have been picking at, which is fair, is that growth has slowed. These guys were putting up same-store sales growth of 10% plus for years, and that slowed down to 3% last quarter. On a multi-year basis, their growth is still well ahead of anyone else, and their unit growth is still well ahead of anyone else in the industry. We think they're going to stabilize and reaccelerate. We think that their value proposition is really the best in the industry. So Domino's, to me, is one that here, trading below peers that are growing at half its rate, I think is going to be seen as a great opportunity over time. But right now, people are focused on others. Just
really quickly, how exposed are all of these companies to an economic slowdown? If they're doing better because the consumer feels healthier, will that be at risk if we do see an economic turndown?
Yeah, so I think the answer is most, especially whenever you're getting most of your sales growth through ticket and not transactions. So as we see that happen, I think Starbucks is a good example of they're doing a lot of the right things for what's happening in the economy right now. So cold brew, et cetera, to drive this average check up and 7% comps. They're probably a little more vulnerable that you could trade down if the economy were to wobble. McDonald's 6% check growth wouldn't be there if the economy was a little bit slower as well. So I think the short answer is all of them would be. I think Domino's would be well positioned with their value. McDonald's would still be pretty well positioned. Burger King as well. I'd probably steer away from some of the higher ticket growers that we're seeing right now.